Target date funds just passed 4 trillion in assets. And a lot of people make this their default in their investment accounts and their 401ks. But is that the smart way? We're going to talk to Dennis today about whether or not target date funds should be a big part of your portfolio and maybe what are some of the alternatives. We'll work through that coming up next. Welcome into Dollars with Dennis. Glad to have you on the show. Once again, I'm Ben George with Dennis Hoare at Faith 401k and Money Management. Dennis, is a good topic and good to see you again. I know this is, I guess, target date funds are just kind of the default, as I mentioned, for a lot of things. And many people just don't really understand them that well and just figure they're a pretty safe investment. You probably see this quite a bit.
Absolutely. Yeah. Target dates have become the thing to go to because they were changed several years ago. The original default or the default for several years was a money market or a very low returning fund over the long term. And if you didn't pick an investment, you ended up there. So the target date funds are a better option than that, but are they the best option? That's probably the question.
All right, so we're going to drop that Morningstar article down into the show notes for you to check out for yourself. But just remember, if you have any questions about how you should be invested in your 401k, it's a great opportunity to reach out to Dennis. This is what they do all the time. They help people investing in their 401k, along with many other aspects of retirement planning to help you reach those goals that you might have for your financial future. You can go to 401k.faith. But as I mentioned, this is pretty big news because these target date funds now just hit a record 4 trillion in assets, according to Morningstar, which is pretty crazy. And in fact, 8 out of 10 Vanguard 401k investors hold one today. So Dennis, when you see these numbers and you try to grasp how big they actually are, do they surprise you at all?
Well, in hindsight, yes, I am. but they are, but looking at our lives today, we're all busy. We're all, we like cruise control in our cars. We like everything to be simple. We want fast food. We want quick and easy, and that is exactly what the target dates were designed to do. They have automatic rebalancing, and just to touch on rebalancing. If you had 4 different investments, if you don't have some sort of rebalance mechanism, you'll get overloaded in one area inevitably throughout a year or over a period of time. So they do rebalance. That's the good news. They have a glide path. What is a glide path? So whatever age you are today to whatever your expected retirement age, which is typically 65 for target date funds, the glide path that starts out more aggressive, more stock oriented, and gets down to more or less stock oriented as you get closer to age 65. And so that glide path is automatic. So it is easy, and it seems like us Americans, we like easy. So it's continued to mushroom and grow, and because it is a default, we're a little bit lazy, and I think that's good for us.
Because, just to give you some kind of perspective on how much that growth is, because it's hard to wrap your head around 4 trillion in assets, but just about 15 years ago, Dennis, in 2010, you're talking right around 275 billion in assets, and that's really just shot up to 4 trillion as we are today. So you can kind of see that this has become maybe the kind of go-to for a lot of investors. And is it just because of the ease, Dennis, or is there some value in the target date funds that investors see, and that's why they're sticking to them?
Wow, good question. So just go back to what you said 15 years ago, the number. So if you're following the rule of 72 and you're in a money market fund that averages 3%, it's going to take 21 years for your money to double. If you're in a 7% return, that's more of a stock growth rate, you're going to double your money in 10 years. So in 15 years, you got 1.5 times more what you started with. So, and then because it's so easy, people are getting automatically, not only the auto investment, but the auto enroll has really increased participation in the 401k, which is, we certainly do need more participation in retirement plans. And so making it simple, making it easy for participants is good for everybody, and it just continues to mushroom. Now, I challenge, where do we go from here, and is it the right place to be? So when you're young and long time to go, sure, you can roll into an investment and not worry about it a whole lot. But I think as we get older and we have more money in our accounts, then we want to start diversifying or making sure that the target is what we want. When are we going to retire? Are we going to retire at 55 or 60? We're going to work to 65 or 70. Do we even know that time? But the horizon, that's I guess the fallacy in target date funds have everybody retiring at the same age, 65, which isn't always the case. And then the allocation is the same for everybody, which might not be the case. So we like to do a personal prayer. I've said many times, given my preference, if I can meet with the employee or person individually, we can set all their information based on their goals, their needs, their wants, and their financial situation, because that is going to be most appropriate for them, and set the rebalancing for them as well, as opposed to just having one custom fund for all ages to do that. So I think there's some real good advantages to personalize and customize it, but their advantages become we're all too busy. We want easy, we want simple, and so people don't take the time to seek out somebody like myself to do that, and many companies don't like to give up that time for employees to do that as well. So that's the next best thing. The target date is probably the next best thing over a personalized portfolio.
Yeah, and you mentioned the assumption that everybody's retiring at 65, and that's kind of like how this targets, how it's investment mix, I guess, going forward. And not everybody's gonna be in the same situation when they get close to 65 either, right, Dennis? So I mean, with these target date funds, they're set up for the general retiree, I guess, but you might need to be more aggressive, or you might need to be more conservative because you're already in good shape. It's going to be different person to person.
That's so true. And I'm going to take a step back to what we talked a while back about Social Security. And Social Security was started in the 1930s. And I challenge people to Google what the life expectancy of Americans were in the 1930s. And I just did it before we started. It says men were 58 and women were 62. And if you look at the original language that was updated 2 years after it started, they had the retirement date for Social Security be age 65. So you have to be flexible. You have to be able to change. And so that's what a personalized portfolio will do, and allow you to be flexible, change to your risk tolerance, your age that if you want to work, some people like their jobs, believe it or not, and so and are good with working and want to stay busy and active. Some people want the shortest path to get out that they can have, and that is it's okay. It's not wrong. It's just, what do we need to do to get there, and how do we do that?
Yeah, so let's help out some people, Dennis, that maybe are thinking about target date funds or just looking for investment guidance a little bit here. What are some things to maybe watch out for as you're exploring different types of funds?
Yeah, so first and foremost, the fee structure. So every investment has a different fee structure. So you want to look at the funds available in your portfolio, see if there are things that are less expensive than more expensive. And I always say expense to what, so net expense versus return. And then there's better places for the active passive. So an active manager is somebody that's in a particular category and is looking for the best options in that category for your investments. And a passive manager is just taking the index of that same category. So you're getting everything in that category. The index is going to be less expensive. The passive or the active would be typically more expensive, but maybe you get a better result because of that. And so knowing those and looking at those things are important. And where do you use active and passive? And this is generalizing things, but I think that active in the bond categories, the fixed income categories, because it's such a broad category, having active managers there versus the S&P 500 as an index for the stock market, much easier understood, and having an index there might be more appropriate and reduce costs. But knowing the difference of the two, and really coming back to what is best for you as an individual, where are your goals? Do you need to be more aggressive, less aggressive, but have a custom portfolio for yourself?
Well, talk to me as we close this out about maybe if you could think of a client maybe that came in with a lot of targeted funds, or if someone did come in to meet with you and had a bunch of target date funds, how would you kind of work through their portfolio to maybe help identify a better mix of investments and come up with a better strategy moving forward?
Yes, I had a couple of times where clients come in and they had multiple target date funds. So they had the 2040 series and the 2050 series, and I asked them why they had it. They said they were trying to be diversified. Well, the target date fund itself is diversified and set on an age. So what we did was take a step back and try to decide, when are we going to retire? What are our needs? Do we have enough money? Do we need more money? Do we need to be more aggressive? Finding out more details about that individual person's situation, then we could build a custom portfolio for them. Whether if you have plenty of money, maybe you don't need to be aggressive at all. If you're planning on leaving more money and you don't need this money in retirement, there's lots of planning ideas that go into picking the portfolio and setting it. But ultimately, we want to have some diversification, and we absolutely want to have diversification in there for people, because markets do work differently, and in different times, and without rebalance, you'll miss some opportunity.
Now, well, if you're invested in target date funds and want to talk with Dennis about maybe a better approach, maybe a more diversified or a more customized mix of investments that fit what you're trying to accomplish and help you get to that financial future with freedom and independence that you're hoping for, you can always get in touch, 401k.faith. And, a big part of what you do, Dennis, is what and why we want to talk about this is because 401k plan consulting is a big part of what you guys do every single day with your clients. And just take us inside of that just quickly as we kind of close this out and what that means and how you help.
Yeah, so everybody's different. And part of the other question is, when do you want to seek out an advisor? When do you want to seek out? So if you don't know one, ask your friends, ask somebody else. You can reach out to us. We're happy to help. But at least, I think 10 years before retirement date, you want to start finding out where you are, what the picture is, because you still have time to adjust. Ultimately, the sooner the better. So we have clients in their 20s and 30s that we're setting their goals and their priorities now for, and being flexible to adjust those as we go along. So at least probably 10 years before you start, but come in and if it's not us, find a professional that can help you in your area and take advantage of the tools that are out there.
Again, 401k.faith. All the contact information is in the show description. Also, you'll find the link to the Morningstar article with a lot of that details on target date funds and the huge growth we've seen over the last 15 or so years. If you have questions, again, please get in touch. And if you've enjoyed this video, if you found this informative, it's helped you out a little bit, please hit subscribe. We'd appreciate that support as well. Dennis, as always, good to see you. Thanks for your time.
Thank you, Ben.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.